Hello, everyone. Welcome to this investment readiness webinar. Today, we're going to be covering pitching. My name is Tim Heijman. I'm a consultant at Evenflow, and I personally learned about startup fundraising when I was living and studying in Los Angeles. And of course, on the West Coast in the Bay Area, there's a lot of investment going on. I studied entrepreneurial finance there, and I took whatever I learned there back to Europe, where I successfully raised several million euros for an aerospace startup here in Europe. And today I want to share with you the essentials of pitching. The goal of pitching is basically it's the first step to raising money from an investor. You want to basically entice them to further explore this investment opportunity with you, and it should answer the fundamental questions that all investors have about your business. It's also a really good way to step back and reflect on your business plan, on your business model, and you want to demonstrate pure mastery of your business. It should be simple, engaging, comprehensive, concise, and it should cover the key topics that we're going to go over today to answer those fundamental questions. Now, before we get into what goes in a pitch, you want to make first sure that you're pitching to the right investor. There's many types of investors. You have, for example, your friends and your family, where you might raise 1,000, few thousand, even 10,000 euros, depending on your network, to get to kind of a minimum viable product. Then you have, for example, banks, which traditionally are not super interested in investing in startups generally, but some of them have programs specifically tailored to startup and SME loans, so you can look into that as well. There's government grants, which are interesting because they often do not require an equity stake in your company, and there's many of them. Public funding opportunities through the European Commission, European Space Agency, and also national initiatives that target these high-tech R&D companies. So they might be specifically suitable to what you're building. And again, they don't require equity, so it's really an interesting option. Then there is accelerators and incubators. It's kind of like a stepping stone towards the larger investment rounds. If you get accepted, often you get some seed money, might be 10,000 euros, might be 100,000 euros. And they also support you in developing your product, in getting some initial customer traction. So it's kind of like a good way to really nail down your proposition and then go to larger investors. Then as for actual investors themselves, you have professional angel investors, which are, let's say, wealthy individuals that invest their own money. You would approach these guys for your pre-seed or your seed round when you need a few 100,000 euros. They are often willing to support kind of smaller operations as compared to the venture capitalists. And they are often also more flexible in terms of the terms and what they can provide in terms of wisdom is also really interesting. And they would invest maybe 20 to 50K per angel, and then they would maybe team up to get you your seed round needs. And then, of course, you have venture capital. So venture capital gets a lot of attention, and it has a certain appeal about it, but it's not always the best vehicle to raise money. So, of course, with venture capital, you're really selling a significant part of your company, and you're entering into a marriage with a partner that has a lot of say in what you do and how you do it, when you do it. They often want to have board representation. They might even leave you with a minority vote, which means that then you're not just hiring your partner, you're hiring your boss. So it's not always the right route if your alignment of what you want and what your strategy is not the same. So an investor might and often wants to prioritize scaling, getting your business to scale very quickly. And your long-term plans might not align with that at all. So if that misalignment exists, and then you have an investor in your board that wants to do something completely different, then you have a problem. So it's not always the best vehicle to raise money. So explore other ways. You have, you might even be able to bootstrap, to use your existing sales to reinvest them, or you might convince a big customer to pay you in advance. There's crowdsourcing. Maybe you can have, the public funding route that we mentioned before. So there's many other ways to raise money, and you need to explore all of them before you really dive into the venture capital route. So as you can imagine, fundraising is a large and intensive process. There's a lot of other things other than the pitch. So what we're not covering today is say, general investment strategy, how much to raise, when to raise it, who to approach, which all depends on the stage of your venture, your industry, your performance, even macroeconomic conditions, investor sentiment, and things like that. And of course, there's the whole investor package, all the documentation that you're going to have to produce in order to get to the next step with the investor. This is all outside of today's scope, but it is something that Evenflow can very well assist you with. So if you're interested in having the full range of support, just reach out to us. So what goes into a pitch? Well, a pitch is basically an opportunity for you to bring clarity to your vision and your purpose, and it should convince your audience of your product and your team, and entice investors to further explore this investment opportunity with you, to hopefully eventually land a deal, right? So one thing to know is that investors see hundreds of pitch decks, and for every 100 pitch deck that they see, they might dive into details and do their due diligence for 10 of them, and then end up actually investing in just one of them. So know that you're going to be pitching to many investors. You will be rejected many times, and each time is an opportunity to do better. And this is something that you should be aware of, because this is an intensive and a long road ahead of you. But a pitch deck all basically want to answer the same fundamental questions. We've split them up here in 10 topics. And if you manage to answer all of these topics well, which is something that in my experience is very difficult to do for many founders, if you do it well, you really have a good edge on everybody else. So we're going to cover these 10 topics today, from your company purpose and vision all the way to the financials and the investment opportunity. Also, it shouldn't take more than 10 to 15 slides to actually answer these questions fully and concisely. So first, your company purpose and your vision. So you want to describe what your company does in a single sentence. An investor should be immediately able to understand what it is that your company is doing, but also get a good idea of what your vision is for success. Here you want to answer questions like, why does your venture matter? Why are you so passionate about this? And why should an investor care enough to join you? So if we dive into an example that we made for Airbnb, Airbnb has a very simple vision, and their vision is that you can belong anywhere. And their mission to back this up is to create a world where anyone can belong anywhere. And we are focused on creating an end-to-end travel platform that will handle every part of your trip. So that immediately gives you the long-term vision where everybody within Airbnb can work towards. But at the same time, their mission is very concrete. They say, okay, we're building an end-to-end travel platform that handles every part of your trip. So you also immediately understand what it is that Airbnb is concretely doing to realize their vision. So that's a good example. Then naturally, you should go into the problem that you're solving. Many people start off right away showing the product and what they're doing, but they don't spend enough time explaining the problem that you're solving. So define the problem or the pain point that your venture is solving, and what has your customer been doing to solve this? You want to answer the question, why is this a big, important problem that is worth solving? So if we take another example here that we made for Uber, Uber is solving the problem that taxis operate inefficiently and generally provide a bad user experience, because you are on the side of the road trying to hail a cab by hand, or you're calling dispatch, which is not a two-way communication between you and the driver, so you don't know where he is. There's no GPS coordination. And also taxis often spend a lot of time looking for a fare, so-called dead time for the drivers. So this is kind of the inefficient taxi problem, which is really easy to understand and for investors to get their head around it. So then, of course, you go to your solution. So what are you doing? You want to present your solution, show examples of the effectiveness for your customers, and you want to highlight kind of the unique aspects of your innovation, and also maybe highlight the improvements over today's solutions, and of course its ultimate value to the customers. So here you answer the question, why is your solution compelling to customers, and what is it worth it to them? Here again, we dive into the Uber example. So the Uber solution is a fast and efficient on-demand service application on your car service application on your phone. So the benefits here is that you don't need to call dispatch. You get immediate confirmation of the pickup, which is very quick, within 10 minutes often. You get a real-time driver estimated time of arrival, and you have automatic payments that you can trust. So immediately you understand, okay, we're building an app, and it's very good for the customer because of this, and this reason. Again, simple and concise is always really an effective way to do this. Then you have your product itself. So you want to present the product's unique value and features, maybe highlight some of the intellectual property that you have that makes it protectable. And also you want to go over your roadmap of your product. Where are you heading, right? So you want to be clear about how your technology will protect your lead in the market and also create opportunities for growth down the line. So here you want to answer the question, why will your product disrupt the existing market, and where does it go from there? So if we stick to Uber, showcase of the product. It's an app, it's available on iOS. You have an easy to use interface. You can set it up in minutes. You have an overview of nearby cars, etc. All kind of interesting product features that you can show. And also they go into, or we go into the near-term developments. So where is the product going in the near term? Okay, we're going to add a carpooling option in the next few months. And then we're going to go into the food delivery segment in Q3 of 2014. So it kind of shows you what you have now and also where you're going and also what kind of growth opportunities exist for this application or this platform. So next up is the market opportunity slide. This should give your investor an idea of the size of the problem in the form of the size of the market that you're addressing. So it should include the aggregate size of the market and your addressable or beachhead market and what you're thinking in terms of market share capture goals. And also what is also handy is to present an ideal image of what your customer looks like. So here you want to answer the question, how big, ripe, and accessible is the market for your solution? Here we go back to the Airbnb example. So an Airbnb target customer is a budget-minded traveler who belongs to the tech-savvy generation. So somebody who wants to save money, but also somebody who knows how to book something on the internet. The total market, and I think these are numbers from back when Airbnb started, they estimated 2 billion euros for the overall trip market, booking trips market worldwide. And of that, they narrowed down their serviceable available market, so the market that they can try to service, to 560 million, about a quarter, which are all the trips within the big market that are booked online. And then we also added here some additional quantitative numbers for the users on competitive platforms to more or less validate that this market exists. And then you have the serviceable, obtainable market. That's the market that Airbnb will try and capture. So in this case, it's 15% of the serviceable available market, which means 84 million euros a year in revenue that Airbnb is targeting. So this is always a really good way to give some context to the size of the problem that you're solving. Then you want to go into the context and competition. So who's your competitors and what are their strengths and their weaknesses? Maybe go a little bit into the historical evolution of your target market. Who have been the bigger players over what time period and why? And you want to differentiate, of course, your solution to everybody else's in terms of your customer value proposition. Also, if your competition is very entrenched, you want to explain how you're going to beat them, right? If your competition is startups, then what are you going to do to outpace them? How are you going to be faster? How are you going to be better? And timing is everything. So you also want to go over maybe why now is the right moment for you to do and to develop your product. Here, Airbnb example. A good way to put yourself into context is to make kind of a matrix on different important topics to your customer. So, for example, Airbnb here we have the affordable versus the expensive, and the offline versus the online transaction. And then you can place yourself within that matrix and place your competitors within that matrix and explain a little bit about what they do and why you are better. Also, what you can do is go over your competitive advantages. So here for Airbnb, we have a first to market, the fact that it's easy to use, that you can use profiles, that you only have to list once, and then everybody can book as much as they want. So they have a bunch of different things that they believe gives them a competitive advantage over everybody else. Then the numbers. So first, make sure that you know your numbers. We highlight unit economics here, which is of course an important one, but generally the advice is really know your numbers, both in terms of like what are your growth rates, what is your churn rate, how much money do you need for what. It's all the numbers should be in your head, easily accessible at all times. So that's kind of a first tip. And here we're going to focus on unit economics. So the amount of money that each transaction will contribute to your operating profit. You want to share your assumptions on pricing, cost of goods sold, supply chain costs, economic value chain, etc. And of course, most of this stuff is going to be inaccurate. And everybody knows that, and that's fine. But you still want to master these numbers because it kind of helps an investor understand how you think about your business, right? So the answer that you want to question, the question you want to answer here is, why will this be a profitable and thriving business? So if we go to Airbnb, well, the business model is relatively simple. Here we say an average booking is usually 3 nights at 80 euros a night. And Airbnb takes a 10% commission on each booking. So that means for every transaction, they expect to earn 24 euros. Now, for a non-hardware company like Airbnb, it's a little bit more difficult to say, okay, it costs me this much to make a product, and I make this much when I sell it, so therefore my gross profit is this. But what we did for Airbnb and for generally software as a service companies, you can work with average selling prices, your gross profit per customer, based on how much each customer is spending per year, and then how many customers are coming back. So what's the useful lifetime, etc. So you can kind of calculate here your customer lifetime value, also the cost of your acquisition cost of the customer, and then you can have like a quick ratio, the so-called customer lifetime value over customer acquisition cost. And if it's over 3, that is considered a sustainable business. So in the case of Airbnb here, we can see the ratio is 5, which is very good. So then you want to go into the team. So the team leadership and the senior management, the board, advisors, you want to highlight all of them, say what each individual brings to the team, and include also your thoughts on any significant gaps that you might have in terms of talent. And this might be something that investors can help you with as well, to source the talent that you know you are currently missing. So the question you want to answer is, why is this the right team to make your venture a success? And how will your organization scale over time? So, simple example from Airbnb, the main guys involved in the team with also their backgrounds. What have they done? What have they successfully developed? And who is their advisor, and also a little note on what they're missing, an experienced software as a service CFO. Pretty straightforward slide, but important because investors don't usually invest in an idea, they invest in the team. So make sure that your team is solid and can get your product to where it needs to go. Then we have financials and execution plan. So you want to provide, if you have a historical financial plan and also a forward-looking one. So consider adding your sources and your uses of capital, your future capital requirements, and also your financing plans. So you want to forecast out at least 3 years, and the earlier stage your business is, the less credible the numbers will be. And as a rule, of course, you want to try and substantiate your near-term plan from the bottom up. So base your numbers on the number of customers you've sold to the number of sales you've made. Not if I capture 1% of this market, then my revenues will be this big. This is often a trap that startups fall into, but you want to substantiate everything bottom up with real life customers. And even though early stage startups have like an inherent uncertainty about them, you still want to be detailed and analytical about your assumptions and the sensitivities of your assumptions and their impact on your numbers. Also, investors will always discount your forecasts because you are a very optimistic entrepreneur. So you want to kind of paint the most optimistic picture that is also, fundamentally sound. So then also your plan should address the total amount of money that you intend to raise before you reach liquidity or your exit. So investors can easily calculate their potential expected dilution and returns. So a good practice here is also to provide market data showing potential returns with outcomes from similar ventures to all kind of like beef up the investment opportunity that you are pitching to them. So here we go over an example. This is really simple financial. So we have key financial forecast that shows the revenues, the gross profit, and your earnings before interest, taxes, depreciation, and also your customer forecast. We made like an example of if you have paying and free customers, how big of the portion is free, how big of the portion is paying, how many customers do you intend to sell to, etc. Then here we have a cash flow forecast. So it's a really simple one. Got your revenues, your gross profit, your operating profit, how much you invest, how much you intend to raise through financing activities, and then the change in cash and cash equivalents and your cash balance. Then you have some sources down below. So you want to say, okay, 2002, we have a 4 million Series A, 2014, 10 million Series B, and then your use of funds. So where are you spending it on? You can spend it on marketing and sales, operations, product development, etc. So those are kind of like simple key numbers that investors are interested in knowing. And then the last slide is the investment opportunity. So we already touched a bit upon selling the investment opportunity to your investor. First, you want to start by outlining your funding history. So who is invested in you? What have they invested? What kind of percentage of ownership do they have? What are the valuations previously? And also show the current capitalization table and the proposed deal structure. So investors, they also care a lot about aligning everybody's interests through stock options. So the employee stock option plan is an important one. So you want to also be prepared to discuss the adequacy of your stock option plan. If you have a lot of talent missing that you know you're going to need to hire, your stock option plan should be large enough to entice and to incentivize those people to join your company at a pretty much probably what's going to be a low salary, but then they have stock options, right? So that's important. So the key question that we answer here is, why is your venture going to be a unicorn providing immense returns for your investors. Here's an example of the investment opportunity. So we go over valuation. Or first, actually, what we're saying is we're raising a 4 million Series A. That goes against a 20 million euro post-money valuation. That immediately gives an investor an idea of what kind of percentage of the company you will be giving away. The instrument, so they're going to be preferred shares will be issued to the investor. What it will do is give you a 24-month runway at a burn rate of 160K per month. That's how much money you're spending every month. And the minimum ticket is the minimum amount of money that an investor needs to invest in order to join your investment round. So if an investor is interested in investing 500,000 euros, here you say, no, not so interested, because we don't want to end up with a deal with 10 investors. We want to have 2 or 3 investors at the most. Then some information on the previous round, your angel round. So that was invested, 500K was invested by the angels, resulting in a 2.5 million post-money valuation, for example. Then also, what are you spending it on? Quick graph, easy to understand. This is then a cap table example. So here basically goes over what the founder and the CEO and the angel investor have in terms of common shares, how much the Series A investors are investing, and what kind of shares are being issued for the Series A, then the total number of shares that results from that, and the percentage of ownership after the round, as an example. What we presented today is meant to give an insight into some of the fundamental aspects of pitching. And all of that should be relevant for all E-Shape startup and SME pilots, or those that are considering developing spin-off activities after the project, and should also be relevant for any entrepreneurial Earth observation solution developer within the EuroGeo community. So we've on purpose selected generic examples, so we don't bias the message towards certain specific Earth observation activities, but all of the key points addressed are applicable to those developing Earth observation solutions. Now, the team running this sustainability booster is ready to provide additional support and guidance, and you can reach us at booster@eshape.eu. And also, we are still developing other activities and webinars around investment readiness. So be sure to keep an eye out on sustainability.eshape.eu. Thank you very much.